Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. Typically joining me today would be Michael Becker, but he is on another due diligence assignment, so we wish him and his group at SPI a lot of luck. They had a great 2020, and I think they're going to have another great 2021. So this is one of my favorite podcast discussions, and we've done this for probably about 5 or 6, 7 years. We kind of do it on a quarterly basis. It's the Loan Officer Roundtable. And what the Loan Officer Roundtable is that a couple of the top producing loan officers for Old Capital sit in and we kind of have a general discussion about what's going on with the market, what's going on with Old Capital, what we're seeing with underwriting, what we're seeing with the, things that are going on within the industry that you should know about. So grab a piece of paper and pencil, and I want you to kind of go through and listen to some of the comments that we make. So you're just going to be, if you're listening, you're just a fly on the wall. And this is kind of an internal conversation for the Old Capital team. But I think you're going to find some good bullet points about what we're seeing right now that you can kind of leverage into your own business and, just make qualified decisions in the future about what you're kind of hearing today. So on the podcast, we have some of the team members for Old Capital. We have Dave Walls. Dave, thanks for joining us. We also have Julie Peterson. Julie, thanks for joining us.
Thank you.
Ricardo Hinojosa, thanks for joining us, Ricardo.
Good to be here.
John Brixon. John, thanks for being here.
Hey, Paul.
And of course, our man who knows everything, the professor himself, Mr. James Eng. James, how are you?
Good. Happy New Year, Paul.
Happy New Year. So we're recording this probably the first week of January, and we're starting to see the 10-year Treasury start to rise. We've seen the protests go on at the Capitol, craziness, everything that's going on in that political arena. Hopefully that'll have some part of resolution at some period of time. The Senate now is, I think, leveraged to 50-50, 50 Republicans and 50 Democrats. And then the deciding swing vote is the Vice President of the United States. So it's going to be a Democratic-leaning piece. And so we're going to kind of get everybody's opinion about what we think that's going to do to the market. So if you think that we bring value, and now here's a little commercial. If you think we bring value, go onto the Old Capital Podcast website, oldcapitalpodcast.com website, download the 17-page white paper report that some of the team members here at Old Capital have written. I think you'll like it. It's kind of up to date about what we're seeing in the marketplace and how to make some judgments going forward. And then we have a Old Capital Speaker Series coming up at the end of January, and we're going to talk a little bit more about that coming on in the next week or so. So we'll talk a little bit about that too. So again, thanks for joining us. Let's get going. I'm going to kick it over to James a little bit. So James, in your perspective, how was the fourth quarter of 2020, not only just for Old Capital, but for the apartment industry overall? What are you seeing?
Yeah, I think, we had a pause sort of April, May, June. I would say July, August, September. Everybody who wanted to list a deal in 2020 listed their deal. And so we had brokers coming out with deals left and right. And it seemed like, there was probably 30 or 40 transactions that had to close in November and December. So we had a huge quarter in the fourth quarter, and it was really driven by, number one, sellers didn't know what was going to happen with the election. They didn't know what was going to happen with tax rates and things like that. So they were just like, we got to get the deal out. And so a lot of deals transacted. So we had a lot of acquisitions in the fourth quarter. But, as much as everything has changed, one thing that doesn't change, I guess, is that the rent is still due on the first. And so apartment collections really they've deteriorated here a little bit. But, with every stimulus package, with every unemployment check increase, the collections have steadily held here in Texas. And so we're seeing collections do well and deals still get done.
Old Capital does a lot of their business in the apartment sector. James, let's talk a little bit about other platforms, whether it is office and retail, warehouse, hospitality. I mean, what's going on in that marketplace? I mean, I can just imagine, but let's put a little bit of a bow on what you're seeing.
Yeah, I mean, I think I saw sort of a green chart sort of starting from one side and sort of working your way to the other side. I think everyone agrees that sort of industrial and multifamily are right there at the top. And the only other retail segment that I think is also in that segment is probably just sort of your triple net, single tenant, credit tenants are probably the top 1, 2, 3 in terms of collections. And then as you work your way down, people are seeing issues really in the retail hospitality space. And then, people are trying to figure out, what do we do with all this space, right? What do we do with all this extra hotel space? What do we do with even some of this excess office space? And so there's been a lot of newer general partners coming out of woodwork here saying, all right, we're going to take that residence in and we're going to convert it to an apartment. And we're going to take that office building or that mall and convert it to another use. And all these people, they want to buy online, but dang it, I want to pick it up in my car and not have it delivered. And so curbside is the new fast food. So you're picking up your hamburger and you're picking up, your iPod on the way home. So, I think that's probably the gist, is that we're seeing a lot of hurt. Actually, one of the largest hotel guys here in Dallas, I actually interviewed to work with them coming sort of out of school, a group called Ashford Hospitality. They own probably 100 high-end hotels, and they've given back about 20 of them to lenders in 2020. And they just got a loan from our buddies at Oak Tree for $200 million. And that is going to save them for this year. So the hotel space, and those guys have been around for a long time, smart guys who have done this for a long time. But this thing has just walloped some of the commercial real estate space.
Talk a little bit about, interest rates. Last week or so, we've seen just a jump up of the 10-year treasury significantly. Kind of talk a little bit about, what happened probably the beginning of 2020 and where we're at right now, and say long-term, which is like 10-year treasuries, and where the short-term, say LIBOR or SOFR is, and that's the index that a lot of adjustable rates are based on. Can you just kind of give us some insight of what you're seeing?
Yeah, I mean, I think sometimes people forget how far we've come. And, I was at a call yesterday, and we did a deal back in 2018 on a Fannie Mae loan, and we fixed it at 5%. And at 5%, we thought that was a dang freaking good interest rate 2 years ago. And back then, the 10-year treasury was 2.75, and it was going up. So we locked it in at 5, and we thought, oh man, this is going to be the best rate. And now, we're sitting here, and 10-year treasury went all the way down to 70 basis points or 60 basis points during COVID. And now it has slowly moved up 30 basis points, but it's still 1%. And, we're quoting and locking deals around 3%. Like a lot of us closed loans that, is 3.15 on 10-year fixed rate money. And so I think overall the environment's still low. I think people have adjusted somewhat in their way of thinking about it. If interest rates are going to stay low for 2 years or 3 years from now, maybe it's okay to take a floating rate loan and take a little bit more risk and be a little bit more conservative on our leverage. But by the same token, I mean, about half the deals that we did were fixed rate Fannie Mae loans that people just took maybe a shorter yield maintenance penalty, and they were okay raising the additional money to have the flexibility to get out of these deals earlier.
I've been banging the table for the 36 years I've been in this business about taking a fixed rate. And I've been wrong every damn day for the last 36 years. And what people should have been doing is really taking adjustable rates, because when I got in the business, if you remember back, home loans were at 16, 17%, and prime rate was at 21%. And there's been there's like chutes and ladders, the game chutes and ladders that you go down the slide. Well, it's been on the slide for interest rates going down from 21% all the way down to like what James was saying in the 10-year treasury down to 0.55, almost close to zero on the interest rate. In some parts of the world, we have negative interest rates. So if you had been on an adjustable rate, you would have, taken it out maybe at 11 or 12% a number of years ago. And you would have been refinancing yourself every damn day with the interest rates going down instead of refinancing to try to chase the rate down. But my take is right now with these interest rates so damn low, one of these days I'm going to be right, and that you should lock in an interest rate where the 10-year treasury is, around 1%, and that, you don't have to worry about the upside potential of rates going up in the future on the short terms, whether that's LIBOR, London Interbank Offer Rate that it's starting to go away, or SOFR, which is kind of the new adjustable rate index. And so, I just see a little bit of a trembling out there with people that may have adjustable rates in the future, that if we start to see short-term rates go up, that they may be tagged. And so anything that you would add on to that, James?
No, I mean, I think you have to look at it and sort of do the calculation. We can help you do the calculation, is really look at, all right, when am I going to exit? And even if interest rates went from 3% to 4% as your all-in rate, but your prepay is 1% compared to yield maintenance, the floater might still win. But it's more just, it feels more difficult. Like, what? You had a chance to lock in at 3%, but we're sitting here floating up to 4%. Like, it feels difficult. It feels harder to explain. And a lot of people who have done Fannie Mae fixed rate, they're just getting used to a new statement that comes every month where it was 3%. The next month it's 315. The next month is 330. And they're just getting a little bit more nervous each month. And so, I think number one, buy the lowest interest rate cap that you can buy if that's one of your issues. But I mean, overall, it'll come out okay. I think the main thing that people are not looking at probably is that the reason that most people did floating rate in the past was they were doing short-term loans. So they were doing 3 to 5 year bridge loans. There's almost like a window of time where Freddie has decided that we're going to do these 10-year floaters. And so you have the floating rate loan, but then you have a 10-year maturity. And so for a lot of these guys, they've been able to sell in year 2, 3, 4 and get out of these deals. But if you have to hold these deals 5, 6, 7 years, you have that maturity. And so that's probably one of the big changes that I've seen, is just that you can get the floating rate loan and longer term maturity to protect you from that gun to your head in year 5.
So what you're really saying, James, is you need to really speak with your old capital loan officer to kind of go through different scenarios that maybe fit what your business plan is on the property. So with saying that, again, people are listening to this, again, a fly on the wall. Again, we're having an internal discussion with a bunch of old capital loan officers, really where the rubber meets the road, and where, people are talking with clients, talking with borrowers, sponsorship groups every day. I want to kind of get their impact and their feedback about what's going on. So again, Ricardo, I'm going to tag you first. So Ricardo Hinojosa, that he's really based in the Dallas-Fort Worth area, does a lot of business throughout the state, Arizona, also Colorado, all over the nation. But I want to kind of get your perspective about really what you're seeing out there. And maybe you can throw out, and I may ask this for everybody, maybe throw out 1 or 2 transactions that you've worked on that you think that people that are just listening would find important, and maybe how you were challenged by it and how you mitigated the risk.
Yeah, definitely. So for me, I think over the last couple of months, a trend has been the toughness around lender due diligence and underwriting guidelines. So we've seen as we progress through COVID, lenders are getting more and more conservative in terms of, proving up the underwritten NOI. And there's a lot of ways to do that. And it's all the way from income, all the way down through the expense lines. From an income perspective, there's a lot more due diligence now from Fannie and Freddie and from the bridge lenders, making sure that we're proving up the income all the way up to close. So in the past, let's say if you had a close date in the first couple of weeks of the month, they really didn't get into making sure or underwriting that current month. So for example, I got 2 deals closing today, and they're both Freddie Mac loans, and we had to show January collections Now, they weren't totally collected, but we had to have a really clear story on what's collected today. And, the delinquents, why are they delinquent? Is there anything abnormal that's happening this month relative to previous months? So a lot of due diligence around, proving up NOIs leading up to close, and then taxes as well. We've seen that in a number of counties, a number of states, primarily Texas, where Freddie Mac is being pretty conservative right now. Freddie Mac conventional products, very conservative around underwriting taxes. And this kind of plays into what James was talking about earlier. I had a couple of deals in the fourth quarter that, for a couple of reasons, going into the deal, we were thinking Freddie floater all the way because of their concern about interest rates, but then also leverage is getting cut with Freddie Mac because of the way they're underwriting right now. All of a sudden, it made a little more sense to look at some of the other options with Fannie Mae. So they still didn't want to do yield maintenance because of the prepay. But to James's point earlier, there are ways to get around that. You can shorten the yield maintenance. A couple of recent clients just wanted to do step down. Hey, they were looking at the floater. The floater made sense, but the leverage was low. So, we switched it over to Fannie Mae. We were able to boost the leverage and then still give them some certainty on the exit with a step down prepay. So it's not 1%. It's not as low as a Freddie floater, but the higher leverage and the certainty on interest rates, being that it's a low fixed rate, even with a step down, we got a 10-year term step down still in the low threes. So that trade-off between a variable rate with an easy exit versus a fixed rate, maybe higher leverage with still a decent exit, might make sense. So,
Ricardo, do you remember the size of that step down, the loan, just roughly?
Yeah, it was $13 million loan was this one that I'm thinking about.
Okay.
This was in the fourth quarter, $13 million loan.
Because, I think one thing people forget sometimes also is that these interest rate caps, whether it's $13 million or $20 million loan, you're probably on a SOFR cap right now. On a 3-year cap, you're probably 50,000, 60,000. Yeah. And then if you hold the deal for 5 years, you go out and buy another cap, and it might be 50,000, it might be 100,000, might be 150,000. Yeah. And so for that client, it probably just made more sense to take the step down on that deal.
He wasn't comfortable with the uncertainty, and then the leverage was lower. So those two things really pushed it over to the fixed rate product. I've seen that on a few deals here recently.
Any more examples, Ricardo?
Yeah. So, on smaller deals, again, it's all around how strict some of these lenders are being around COVID. So on smaller deals for first-time borrowers, so we get a lot of first-time borrowers that we work with. And in the past, with the Freddie Mac Small Balance Program, which is a very popular loan product for first-time borrowers, we were able to kind of get around, them being a first-time borrower with experience from the third-party management group. So as long as you came in, you could show us that your management company has experience in that market. We were able to get you max leverage, max IO. But what they were doing now is we're having to go through upfront and get a waiver. And in most instances, what Freddie is doing is they're cutting the leverage and cutting the IO right now for first-time borrowers. So in this example, we're closing this deal next week. For an experienced borrower, it would have been 80% leverage. They cut them down to 75. And for an experienced borrower, it would have been 3 years of IO. On a 10-year term, they cut them down to 2 years. Now, this is something we knew going in. This wasn't a last-minute surprise. Again, we vet this stuff out up front, so you know exactly what you're getting. But that's kind of what we're seeing on small deals for first-time borrowers. That's something to watch out for right now.
Yeah, I'm definitely seeing Freddy SPL tighten up the box. I got a call from an out-of-state investor trying to buy a deal here in Texas, and they didn't have any previous multifamily experience. And they had a third-party property management company, and then they said, we're going to crank you to 18 months P&I reserve instead of the 12. Yeah. And so that was enough. Like, everybody likes Freddy SPL. It's non-recourse. It's got long-term, 30-year amortization. But then all of a sudden, 18 months P&I on a small deal is a lot of money. And, it wasn't like they could just add. It wasn't a syndication. It was somebody with their own money. You can't just add somebody to that group. So I think when we were talking about some deals last week, I think John brought up a good point, just sort of around, back when sort of Paul was doing a bunch of recourse bank loans back in the day, back early in this cycle, in the last cycle, that might be an avenue. So I don't know if Ricardo, if you had anything on that, or if John, you wanted to chime in. Yeah.
I mean, I had 3 or 4 discussions this week. So I think over the last few weeks, we've seen some more community banks start to open up a little more, getting a little more aggressive on rates. So I definitely see that coming over the next, Q1, Q2, where we start shifting things over on some of these deals to community banks, just because we're seeing a lot more options here recently.
And actually, James, I'm surprised to hear that Freddie was willing to do the deal with 18 months of P&I, because everything I'm hearing on the Freddie small balance side is that no experience and first-time investors and out of market is kind of a non-starter right now with Freddy SPL.
Well, I wasn't working that deal. They called me to save the deal. So that was the initial cut was, hey, we think we can get it. So they maybe did a pre-screen or something. And I mean, sometimes this is what happened at GE. The chief risk officer would make the deal so bad that they wouldn't say no. They would just put all these conditions and covenants that basically told you to go away. And so I think that was one of many that told them to go away.
Well, we don't want to have John Brixon go away. As you know, John Brixon is from originally from Kansas City, lives in the Texas, Dallas-Fort Worth area too, works throughout the nation, providing debt and equity to groups. John, what is your take? What are you seeing out in the market right now? Any words of wisdom?
Yeah, I mean, I think, to James's point a few minutes ago, and also just kind of talking about the small balance space, I would say that Fannie and Freddie have tightened the box a little bit on their underwriting standards, and it is taking a longer period of time for them to get through due diligence to underwrite some of these transactions. I mean, Freddie small balance, they're taking 60 to 90 days to close. They're asking for 6 months of bank statements. They're not financing, newer or first-time investors as frequently as they were in the past. And so I've been with my, borrowers who are buying the smaller properties, the 30, the 20 to 60 unit properties. I'm really saying, hey, look at financing this with a bank loan, with a local bank loan. And, on the other side of it, I think the banks have actually gotten a little bit more aggressive on underwriting multifamily properties. For instance, I'm looking at a bridge loan right now in the DFW market, and I'm looking at talking to non-recourse bridge lenders, and I'm talking to bank lenders as well. And I have banks that are quoting it at 75 to 80% loan to cost with 2 years of IO, 25-year AM thereafter. And that would have been kind of unthinkable with banks, I think, a year ago. And part of what's driving that, I think, for banks is, like we were talking about earlier, they really can't lend. I mean, office is having issues, hotel, retail is having issues. So right now on the real estate side, multifamily and industrial and self-storage are really the only 3 property types that they can lend on. And then on the other side of it too is, banks are making loans to small businesses and medium-sized businesses, even corporates. And I think it's harder for them to make loans in the C&I space based on, what's happening with COVID and uncertainty there. So, and then on top of all that, banks are flush with cash with all this stimulus. So I think banks actually are well capitalized, and they're looking for ways to put money out, and multifamily is a good option. And so for a lot of these smaller transactions, I'm really pointing a lot of my borrowers to, hey, finance this with a local bank, close in 30 days, go in, improve the property, increase the cash flow. And then once it's ready, go and refi it with a Freddie small balance or a Fannie Mae small loan. And I think that model works. And I think that's actually been a pretty common model for a lot of investors in other parts of the country. Here in DFW, people have always financed with agency on acquisitions. But I think financing with banks on acquisitions make a lot of sense. And just to kind of give you a quick case study, I mean, the last loan that I closed of the year was my smallest loan, but maybe also my favorite loan that I closed of the year, because it was a $1.3 million loan. It was a repeat borrower of mine. Her and her husband are both radiologists that are based out of state. And every year, and they're able to qualify for the real estate professional designation because they own enough real estate. I think one of them works as a radiologist part-time. They spend enough time managing their real estate portfolio and that they're able to qualify as real estate professionals. Well, because they qualify as real estate professionals, they're able to apply their passive losses from multifamily or owning multifamily towards their W-2 income. So for each of the past 3 years, they've bought a small multifamily in DFW, ranging in size from, well, this last one was 6 units, but 6 units up to 60 units. And they've had zero tax liability, on their W-2 income and their investment income. So they've paid no income taxes at all for the last 3 years, and good real estate. And so this last property, it was a 6-unit townhome property. Average unit size was like 1,500 square feet, but great location in lower Greenville area of Dallas, core infill location, and 2013 construction. All these units have attached garages, really nice product. And I think a lot of the people in the market were overlooking it because everyone's looking for value add. People would rather buy a 1968 chiller property at a 4.25 cap and go in and improve it and increase the value and stabilize it at a 5.5 cap. Well, these guys are buying a property at a 5 cap where it's 2013 construction, but the owners out of state, they haven't been looking at it. In-place rents are $2,200. They should be $2,500 for this location, this type of product. So they bought it. We financed it with a bank loan. This bank was willing to go to 75% LTV, even though the going in debt service coverage ratio was at or below a 1.0. The bank really looked at the strength of the guarantor and what their personal cash flow, what their personal income was to get them qualified. And the bank closed in 27, 28 days. And they'll buy this property. They put in a good third-party property management company. They'll get the rents to market, manage the expenses, how they should be managed. And then when they're ready, they'll refi it with agency and they'll hold on to it long-term.
That's a great story. I love that story, not because they're saving so much in taxes, but they're buying good real estate and they're buying high quality assets in an area that will continue to appreciate that. Tell us a little bit about, you had done a transaction for a long-term client of ours that was converting a property over from a chiller system to individually metered HVACs. Can you talk a little about that deal? Because I think that one's, when somebody buys some of these older properties, you were talking about the 40 or 50-year-old properties that were built in the 60s and 70s, the technology that was being used at that period of time was the greatest and most efficient. Today, not so much. With underground water pipes for heating and cooling, it becomes much more difficult to not find these porous holes in these pipes that kick up water underground, and then all of a sudden they start bubbling up. So you had a client that said, I'm going to buy this property, but I'm not going to keep it the way it was originally designed. Talk to us a little bit about that one.
Sure. Yeah. So this property, we closed that the day before the bank loan that I just talked about. So we closed this one, I think, on December 29th. And this is a terrace view in Grand Prairie, 191 units. It's the property where you're driving along I-30, and on one side of the highway, you see the Ripley's Believe It or Not Museum. The other side of the property, you see this big, ugly all bills paid sign on this old multifamily property with window unit AC hanging out of the windows. And I've always driven by it and just thought, man, someone's going to buy that someday and fix that thing. But basically, this property, had just about the lowest rents that I had seen on a multifamily property in DFW. I think the 2-bedroom units, I want to say we're running for $800, all bills paid. And meaning that the tenant is paying $800 and they're not paying for the electric, water, sewer. They're not paying gas, like no utilities on top of that. And so, if your monthly utility bill is $150, if you're comparing what they're paying apples to apples with other all bills paid multifamily properties, those 2 bedrooms are renting for like $650, which is just like incredibly cheap for DFW. So this property, was basically 100% occupied. I mean, it's 189 out of 191 units were occupied because the rents were so cheap. And what this property also had was, as Paul mentioned, was a chiller system, which is pretty common in a lot of these Texas markets, and was really the high-end technology or the innovative technology back in the 60s and 70s on some of these multifamily properties, and the best type of cooling system for multifamily properties back then. But this chiller system was effectively not working. So all of these tenants were using window unit AC, which is not very common, here in Dallas, Fort Worth. I think in some of the markets up north or out in California, it might be more common to have a window unit or a wall unit AC, but they were using window unit AC because the chiller wasn't working. They weren't getting central AC. And so this borrower, who, very experienced multifamily owner and operator, very good at buying some of these broken Class C multifamily properties, going in, fixing the systems, and then flipping them to, the next wave or the next stage of value add buyer. He wanted to convert it from a chiller system into individual HVAC, which is a pretty big undertaking because it's not just putting in individual HVAC units outside of the property. You have to completely overhaul the electrical system because these older properties, they might not have the capacity that's needed on their electrical system to operate individual HVAC. I think they have to do a good amount of work on the plumbing systems around the property. So pretty large undertaking. I think, his CapEx budget was $15,000 per unit. And, he did a lot of work on the front end and during the physical due diligence with his electrical contractors, with the subcontractor that was going to handle the whole chiller to individual HVAC conversion. And, I think his total cost to do that conversion was like $6,000 or $7,000 per unit is what it came out to, and then in addition to that, he has another, I think, $9,000 a unit in CapEx, which, really isn't even enough for this property. And I think when he goes to sell it in 2 years, there'll be plenty of meat on the bone for the next buyer. But, his thought process was, okay, if I can convert it from a chiller to individual HVAC, I can benefit in two ways. For one, I can improve the quality of the renter because a chiller system is a non-starter for a lot of different renters. A lot of different renters have just gotten burned by having a broken chiller in the summer, on another property. So they say, I'm not going to rent in a chiller property. So they get better renters and higher rents. But then on the sale, chiller systems are a non-starter for a lot of buyers for the same reason. A lot of buyers have gotten burned by having faulty or problem chillers. And so when he goes to sell it, they should have higher income, but then also be able to sell at a lower cap rate just because they'll be able to attract a larger buyer pool. And some of those buyers who wouldn't consider this property in the past now will consider it because you've got individual HVAC.
Talk to me how did you finance that deal? I mean, that's a tough one because you got 100% occupied property, but you have to do a lot of rehab to the deal. And so that's not going to be a Fannie Mae or Freddie Mac loan because there's so much rehab to be done on the deal. Talk to us how that was done.
Yeah, so we financed this with a non-recourse bridge loan. And, it wasn't the easiest loan to place. We started talking to lenders back in, I think, early to middle of September. And, the multifamily financing market, Fannie and Freddie really stuck with it throughout COVID. And the bridge lenders have really started to come back a lot more and have gotten a lot more aggressive in the last quarter of 2020. So in September, they were really just starting to come back in. And so we showed it to, I think, 18 different bridge lenders. And I want to say we probably had 6 or 7 of them quoted it. And then 2 or 3 were pretty competitive on quoting it. So we financed it with a non-recourse bridge loan, signed the loan application end of September. We actually didn't close until end of December. So it was a 90-day close, largely because the buyer was funding part of the acquisition with 1031 proceeds from another property that they were selling in DFW. And that sale got delayed. But we financed it with a bridge loan. Bridge lender did a lot of due diligence and work on their end. They did a great job of really understanding the transaction, walking through it with the borrower.
So the non-recourse bridge lender. So what would those rates be? 11, 12, 13%, John?
Our all-in rate was 5.25% at close, or maybe a little bit lower, 5.15%. And like I was saying, we closed that in September. I think if we sign that loan application in September, if we sign that loan application today, I think the rate would be 4.25% to 4.75%, just because bridge lenders have gotten a lot more active. So, a little bit higher rate, back then, or rates were a little bit higher back then, but the risk profile was also different because, this is a property that, 15,000 a unit in CapEx, 1968, 1969 property. And there was, absolutely no cash flow going in. I mean, they were, I think, at like a 0.8 debt service coverage on like the initial advance. So large interest reserve to cover that shortfall, a lot of structure around that loan. So
that's a great job on that one, John. James, anything more to add to that deal?
I think on a lot of these bridge lenders, obviously the more competition that you can provide, the better. And on this particular transaction, we just had to show it to a lot more people because of the high CapEx and the low debt service. So but overall, great job.
All right, guys, I think we'll stop it right there for the first part of a two-part series. We've got some great information that came out of James Eng and Julie Peterson and John Brickson, Ricardo Hinojosa, and Dave Walls. And we certainly do appreciate everybody listening and kind of being flies on the wall of an internal discussion with the Old Capital team about what is going on. And hopefully some of that information can be translated to help you in your quest of multifamily investing. So we look forward to hearing from you from next week. For segment number 2, we'll kick it off with Dave Walls, who hasn't had a chance to talk a little bit about what he is doing these days. So we look forward to rejoining you next week. So again, I'm Paul Peebles. Have a great day.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.